Good afternoon, everybody. Welcome to the weekly precious metals and commodities video. My name is Jeffrey Halley. I'm a senior market analyst here at Oanda in Singapore. Been a very interesting weekend, to say the least. We had some very poor non-farms data, well, relatively poor in the scheme of things. On Friday, which saw a bit of a dollar sell-off, but that all changed very rapidly over the weekend with North Korea allegedly testing a hydrogen bomb. For those of you who don't know, a hydrogen bomb is a lot more powerful than a conventional one, and it is certainly a game changer, and that's how the market saw it on Monday morning. With dollar yen gapping lower and gold, silver, precious metals, safe haven trades all gapping much higher. With that, we might as well kick straight into gold, as we see on the first chart here. We can see that it's gapped higher on Monday morning. Let's have a looky here. We can see yesterday we've opened around 13.23, raced all the way up to 13.40ish before settling around 13.34 to close the session last night. Continuing this breakout from through the 12.96 triple top, which is now key support, pivotal support. This ascending trend line we have here comes in at around 1289, 1290 will be the next support level behind that, and then we have this 1280 region down here before we start looking at the 100-day moving averages. Looking at the RSI, I think this is the most important thing to note at the moment. It's extremely overbought. This is a trend we'll see through the rest of the precious metal set as well, which implies that if we get a sideways consolidation over the next few days, that could mollify the effects of this RSI being overbought. But the chances are reasonably high that we could see a bit of a downside correction in gold just to take the heat out of this. Having said that, news headlines will overrule any technicals, and should we see any other headlines coming out between the United States and North Korea, we could see another spike higher. So traders should be watching their news feeds fairly carefully this weekend, or this week, I should say. We should find some support around this 1320 area. It does look like in early London this afternoon we are seeing the start of a bit of a correction, but as we can see, this RSI is still very overbought. Once we finally break through and consolidate above this 1337 region, my next target is 1376 on the technicals. 1375, sorry, would be the next region that we would see. But definitely traders should note that RSI. We head over to silver. We broke through 1776 very easily, in fact. That was again the North Korean headlines yesterday. We've gone straight to go without passing past jail, and we raced all the way up to just shy of 18 actually, which will be probably psychological resistance on the way up. Again, much similar to a similar setup to gold. Nearby support here at the 1776 breakout area, which will now be a technical pivot level, and behind that we have this fairly solid level around 17.39. Below that, we actually do have quite a lot of wood to chop, though. This is a fairly solid support region from a technical point of view. The 100-day moving average sitting down here at 16.85, and the 200-day at 17.07, followed by this long-term support ascending support line, which sits around sort of the 17.05 area-ish. So we do have a lot of wood to chop in this region should there be quite a big pullback in silver. That's actually a little hard to see right now, but traders should also note here it's not as overbought as gold, but it is definitely in the 80+% extreme overbought territory. So again, perhaps the technicals are telling us there could be a pause for breath. Heading over to platinum. At the risk of repeating myself, sounding very much the same again. Let's just squish this chart up a little bit. Platinum has been testing, if we look over to the left here, the 78.6 Fibonacci. It's around 1012. We did have a look at it on the North Korea spike yesterday, trading up to around 1015 before falling and giving back most of those gains. Today, it's had another look at the 78.6 level, and that would be sort of 3 tests of this now. So this level is shaping up to be a fairly important level, this 1012. We've definitely had a look at it again this morning, around to 1011 before falling towards the low end of the day's range into early European trading. Again, the RSI is overbought, not quite as bad as silver and gold, but definitely something to note. We can see over here, the last time we got into extreme overbought territory in the middle of August, we did have a fairly meaty correction there of some sort of $40. So just something to be noting. Key support here is this ascending trend line again, and that's around 986. So those are your 2 levels. Above here, of course, the next target, if we consolidate above that 78.6, becomes, if we look over to the left, 1045-ish. And we will reassess after that, should we see it. Palladium, the metal that just keeps on giving. And this week has brought, again, no change to that outlook. We can see here the gain. This is from the non-farms on Friday. It raced through this 941 area, this consolidation region that I've just been highlighting here. That's definitely been the way that Palladium has tended to trade over the last while. Consolidate, move up, consolidate, move up. So these two, this 919 support line is probably the more important of the two. And below that, we get to this trend line. Let's just squash this chart up again. Yeah, this ascending support line here, this rising support line goes all the way back to around October, November last year. It's held it very, very well on every single dip. This comes in lying smack back between the 100 and the 200-day moving averages. Today, that's going to be around sort of the 824.25 region, 860 for the 100-day moving average, 807 for the for the 100 and 807 for the 200. This is your long-term support region. This below this period of consolidation here, which is also a previous high. This 919 is the key. Again, looking at the RSI, we are in approaching extreme overbought. We're probably sitting around 70% at the moment. Not quite as bad as the gold and silver again, but definitely something to look at. Having said that, Palladium has basically been from bottom left to top right for the past year, and really there's no signs at the moment that trend is turning at all from a technical point of view. Copper. Let's just move this bad boy over. Not much more to say on that one too. It is certainly reflecting of the general feeling that the world economy is doing very well, most particularly China. No surprises in the PMI data today. We have the Kaizen one, I believe, tomorrow, but I don't imagine that affecting the prices too much. Key support region is the bottom of this consolidation pattern, which is around 284.70, targeting 3.30, this longer term support region. Again, the RSI is moving towards an overbought area up towards 80, so perhaps some caution would be noted in the short term. Perhaps there is a chance, the technicals are saying, that we could have a small pullback, but frankly this trend is very, very strong. Again, moving up, consolidating, moving up, consolidating, moving up. And I'm reading an interesting report today that Glencore was saying that the average electric vehicle uses 140 kilograms of copper wiring, and they're quite bullish on copper, perhaps talking their book a bit. But if we see electric cars take off, and this is part of the reason behind the rally in copper itself, demand can really perhaps only go one way in copper. So goodness knows where they're going to find it all, but it's certainly good for copper miners, I would suspect. But yep, certainly no change there in the trend. It's still looking very strong, and no reason from a technical point of view to get nervous about that. Natural gas, head over to energy. It's been pretty dull, natural gas, for quite a while here. It's been sitting in this consolidation pattern for what seems like forever, sort of between 3.107 and 2.75 on the downside here. Interestingly, now though, over the last week, given Hurricane Harvey, and we'll talk about that in a little bit with oil, we do seem to be seeing some signs of life. Natural gas does seem to have broken out of the top of its recent consolidation range, which is around 301.80. It's just flirting with its 100-day moving average here, this red line at 30127, and it closed above that, right on it yesterday, and a close above that could be construed as a positive technical development, which may be implying that we would be retesting the 200-day moving average, which is a 308.50-ish, and of course this key resistance line at 310.70. We are nearing the end of the US driving season, and I guess they're starting to look towards autumn, and no surprises that natural gas consumption itself usually rises in winter as people use it for heating, etc., etc. So potentially a positive development here, but in order to get bullish on natural gas, we really do need to see a breakout of this 3-month consolidation pattern. Excuse me, sorry about that. Let's head over to energy now, over to oil, I'm sorry. And of course, we will talk about Hurricane Harvey. US refining last week, 25% of United States' refining capacity was offline and underwater, mainly closed because they didn't know what the extent of the damage or the flooding would be, and simply because workers probably couldn't actually get to the refineries to go to work. This week, though, it's come back with a hiss and a roar, and we are down now to only about 5%, I believe, of the US refining capacity is now offline. Bear in mind, it does take about a week from the time you switch the on switch on on a refinery for it to actually get back to full production. What has this effect had? Well, mainly that's been seen in gasoline futures, which have fallen by about 4-5%, I believe, this week. There was a massive squeeze on distillates and downstream products that the refineries produced. I mean, the oil fields were still producing oil. That's had to go into storage. Now that the oil has can come out of storage and into the refineries, that's boosted prices, as we'll see in WTI, and it's actually taken away that shortage premium on things like distillates and gasoline. Brent crude itself continues to consolidate near the upper end of its recent consolidation pattern, which is sort of sitting around roughly 50 to 52.70-ish. We're comfortably now, we've had multiple daily closes now above this 200-day moving average at $52 a barrel, and we're flirting with this resistance here at 52.60. Next major resistance is up around the 53.45 area, and a move above there would open 54.50. Downside, again, this 200-day moving average will be at 52 will be an intraday pivot, so we could expect from a technical perspective to see a bit of a drop down in Brent crude if it fell through that, and then we come down to the 100-day moving average at 50.15, followed by the range bottom at this 49.85, and the technical pattern does look quite constructive. And that would only really be called into danger, in my interpretation of the charts, if we started seeing a few closes below this 49.85 region. Brent crude itself has just been has struggled to make headway to the top side over the last few days. I believe a lot of that is to do with selling of the Brent WTI spread. Traders have been selling Brent crude and buying back WTI. That spread blew out to multi-year highs of $6 last week. It's been averaging about $2 for most of the year, and it's back to around about, according to my notes, $4.85 today. So we could continue to see that selling of this Brent crude WTI spread having some short-term effects in the market as traders rebalance that premium. WTI itself, as I said, has gained some support over the last couple of days, from traders unwinding that price differential between Brent and WTI. We have now closed above this little resistance line, which comes in at the bottom of the day's range around 47.20 today. That will be a pivot level. It also coincides with the 100-day moving average, which is sitting at basically exactly the same level, which makes it clearly a pivot area. We would expect to see an extension down to these lows around 45.40 if that was to break. But for now, now that most of this refining capacity is back online, and they can clear that backlog of oil that needs to be made into distillates and gasoline and everything else they make out of it. That's actually been supportive of prices as opposed to last week, where we were definitely seeing downward trend from that Hurricane and Harvey induced flooding. Upstairs we have resistance here at this 200-day moving average, 49.3, and then around this 50 region, unsurprisingly, 50.2. We will have some more resistance here, the recent range highs. Let's have a look at, let's go over to the softs now. Lend me some sugar. So we seem to have unwound a lot of that ethanol-based Brazilian induced rally from last week, where they slapped that duty on imported ethanol, meaning that producers in Brazil, which is one of the largest sugar producers in the world, would have changed their, instead of refining the sugar into stuff that hardens our arteries, they would have actually sent it off to the ethanol plants to be made into ethanol. We've seen selling coming back into the market from speculative funds. Looking at the commitment of traders report that came out yesterday, we are now again at record shorts in the market in sugar. So there's record speculative short-term positioning, short positioning in sugar at the moment. So the big guys are clearly thinking that there's more downside now. The RSI is solidly neutral, so they may not be too flawed in their outlook at the moment. Having said that, when you do get record shorts and speculative futures, that does leave the market vulnerable to short squeezes. Intraday, shorter-term supporters around this 13.50 level. And then this 12.8 level, but the major support, of course, is this 12.5 region. Up top, we have the 100-day moving average now, and we note here that it has actually failed a few times here ahead of this 100-day moving average. So this is taking on some significance for me. That's sitting around 14.42 today, so that will be a very important short-term resistance level, followed by this larger level from this consolidation range at 0.15000. Corn. Again, the commitment to traders report showed that there'd been a lot of speculative short positions added to the corn market, so open positions on speculator traders going short of corn. As I said, when all the speculators get very strongly one way, this can actually leave the market open to a short squeeze. And this pattern here, this huge move up in corn on Friday, I believe is exactly that. We can see that the RSI as well had got to very, very oversold levels, and boom, here we are. We've moved all the way back up again. So that is the look of a late Friday massive short squeeze into the weekend sort of market about it. We've broken out of this this resistance line in a fairly bullish development. That is sitting now today around the same level as key support, which is at 329.50. So we may have some more legs in this from a technical perspective. From the technical side, I really can't see any resistance here in corn until this 360 level, which is where the 200-day moving average is, followed by this 350 level with the 100-day moving average. So the technical picture suggests that we could continue to see a squeeze in short corn positioning, just because all the speculators have got themselves very, very seriously one way. Soybeans. has continued its rally that we talked about last week. We did have a down move again as traders generally sold commodities, futures, everything from hogs through to corn, soybeans early in the part of the week. We have seen again that short squeeze coming in on Friday, but that's been some fairly positive bars there. We've got 3 consecutive higher lows and higher closes. We've moved back up through this trend line, which today lies at 948, and also through this 100-day moving average. Now, if we move through the 100-day moving average and close above it tonight, now that's sitting around 950.60. That would be a fairly bullish development. Obviously, we have some quite serious resistance here at 9806. Which is this previous high, but also it's the home of the 200-day moving average, which is lying very, very nearby. And when these lines all coincide, to me, that suggests that they're fairly important levels. RSI is pretty neutral. I think what we're seeing here again is mainly a short squeeze, though. Finally, let's look at wheat. We're seeing the same pattern there, but you can see just how far wheat has come in the last couple of months. It's been fairly dire. We're seeing, if we blow this up a bit, again a short squeeze, but it certainly looks like a dead cat bounce in the greater scheme of things. Let's just squash it up again. Key support here is clearly this 393.70 region. The market is still under pressure in wheat, although they are experiencing drought conditions across North America and Australia and Canada. What's really happening, the news is this record monster harvest that the Russians have produced this year, which seems to have the ability to actually fill in any gaps in the wheat market globally over the course of the next few months. So that is continuing to weigh on the wheat futures and the wheat CFD you see here. Again, we were extremely oversold RSI levels here at the bottom of the chart. We stayed down there for a few days, and this short squeeze has actually pulled it back up into neutral territory. We have the 200-day moving average 424.40. This high around 414.90, let's call it 415. I think it has a lot of wood to chop looking at this chart, and although we have had a squeeze and a small bounce and the scale of the move down over the last few months, it certainly looks more like a dead cat bounce for now rather than a structural change in the wheat market. Okay, well, that's it from me. I hope you found this useful, and I wish you all a wonderful week and good trading out there. Thanks for listening, and take care.